Hi, and welcome back to the LLQP video series presented by Business Career College. I'm Jason Watt, and for the next 10 minutes or so, we're going to be talking about term life insurance. Now, you've already seen a little bit of an introduction to term life insurance when we looked at the overview of life insurance products. Hopefully you've already read this in your textbook, but we're going to just spend a few minutes here talking about term life insurance. Now, term life insurance is a fairly straightforward product. A lot of what we see in the way of term life insurance really didn't develop until post-World War II, prior to really the baby boom generation, or prior to the types of retirement people started to do in the days after World War II. We didn't really have a need for term insurance with all of the various iterations we have it in today. But today, with people living longer and having retirements, now retirement savings is a lot more of a concern. People generally have larger debts than they ever had in the past. And because of all of these things, term insurance is a valuable product today. Now, term insurance is pretty simple. And I've drawn here a grossly oversimplified mortality table. We could graph out mortality just in this way. If you look at in the early years, you're going to have a low cost of insurance increasing over time. So with a term insurance product, the most basic term insurance product, a one-year term product, you would acquire your term insurance and it would run out at the end of 1 year. The pricing would be based on your attained age. The next year, you could go back and reacquire that term insurance. There's almost no opportunity today to actually buy this kind of product. You will find, outside of specialty markets where we're insuring people for travel to very dangerous parts of the world, you won't find typically this type of thing done anymore. But it still provides the basic model for term life insurance. And what we see then is you buy this 1 year non-renewable term insurance product. Okay, great. At the end of the year it runs out. It's not really suitable for most clients. So instead, what insurance companies have done is they've built in a feature called renewability. So with this renewable feature, you can go from one term to the next without having to provide evidence of insurability. So at the end of the term, you go to the next term, no evidence required. And so on. You just keep moving from term to term, and so on. But for most people, a 1 year term is really not ideal. A 1 year term means that next year your cost is going to increase, and the year after that your cost is going to increase. Put yourself in the shoes of the client who's told, I'm going to sell you something, it's something you need, but every year the cost is going to increase. Well, maybe that's not for me. I don't know if I can handle increasing costs. My pay doesn't really increase by that much every year. So what am I going to do? Well, how about this, client? And these are the types of changes now that we started to see in the days after World War II, in the years after World War II. We started to see these changes where we would have maybe 5 years lumped together. So you would pay a level premium for 5 years. And then at the end of that 5 years, if you wanted to keep going with your insurance, no problem. We would allow you to renew and take that insurance for another 5 years. And then that would go for 5 years. And at that point, you could renew again for another 5 years, and so on. And as discussed earlier, there would be some point at which you would no longer be able to renew, maybe at age 75. So the product runs out at age 75. Maybe 80, maybe 70, who knows? Now, 5 years is good, it's better than 1 year, but if you're thinking about your mortgage, for example, well, you're going to be in your mortgage for longer than 5 years. If you're buying term insurance for the purpose of covering off a mortgage, a 5-year term is probably not great. You're going to have 4 increases in price over the life of a typical mortgage. So why don't we draw that thing out a little bit? How about we extend this so that we average out the cost over not 5 years now, but 10 years. So we might do something like this. And then at the end of that 10 years, if you want to carry your insurance for another 10 years, we would take the next 10 and average that cost together.